Imagine building a company that, you know, absolutely dominates a half-trillion rupee market.
Right.
Like your top-line revenue just jumps 42% in a single year. Your profit margins are expanding rapidly, and you've designed this system where commercial landlords are literally paying to build out your product for you.
Which is crazy to think about.
It is. I mean, you are the undisputed king of this massive structural shift in real estate. So by all laws of corporate physics, your stock should just be completely untouchable.
Oh, absolutely. It should be flying.
Yeah, but then you look at the ticker, and Wall Street has, well, they've effectively decided your model is broken. They just erased 50% of your company's market value in a matter of months.
Yeah.
So today, for this deep dive, we are opening the financial black box of Awfis Space Solutions.
And that tension, right, that tension between their total operational dominance and this brutal stock market punishment is, I mean, it's arguably the most fascinating puzzle in Indian real estate right now.
Oh, without a doubt.
Because we're looking at a company that has, fundamentally rewritten the architectural and the financial blueprint of the modern workforce. Yet they're being heavily penalized by the exact same investors who usually reward this exact type of disruption.
Right. So let's unpack this. Our mission today is to dissect this massive stack of financial analyses, operational metrics, and stock story reports we have surrounding Awfis. We need to figure out how exactly they're capitalizing on this post-pandemic real estate boom, and then break down their dual revenue model, which is brilliant, but as we'll see, carries some hidden fragilities.
Right, some real structural risks.
Exactly.
Yeah.
And finally, we have to solve that core paradox, right? Why their underlying revenue growth is telling this triumphant story while the stock price is screaming a completely different, much darker narrative.
Yeah, so to set the baseline for you, we have to just look at the sheer physical footprint Awfis commands right now.
It's massive.
It really is.
Yeah.
As of March 2025, they operate 208 centers. And that translates to over 134,000 operational seats spread across 18 different cities in India.
Just, I mean, let that sink in for a second.
Yeah.
I was looking at that 134,000 number in our sources, and if you really think about it, that is the working population of an entire small city.
Basically, yeah.
Clocking in every single day under an office roof, and the pipeline shows them pushing toward 243 centers and like over 164,000 seats.
Which means they aren't just some regional player anymore. They have built a sprawling pan-India infrastructure network. They are aggressively scaling.
But to really grasp why this company matters, we need to move past this this superficial idea of what co-working actually is.
Oh, definitely.
Because I think a lot of people still equate flexible workspaces with, a couple of independent graphic designers sitting on beanbag chairs sharing a Wi-Fi password.
Right, the old startup cliche.
Exactly. And while Awfis might sell a day pass to a freelancer, that is just a microscopic fraction of their actual business model.
Yeah, I mean, the modern flexible workspace has evolved into enterprise-grade physical infrastructure.
Third way.
Awfis is selling these customized private multi-year office deployments for massive multinational corporations and heavily funded startups.
We're looking huge scale here.
Right. We are talking about designing and operating isolated floors that accommodate, 500 to 1,000 employees for a single client.
Wow.
They provide the enterprise-level server security, the customized boardrooms, the acoustic engineering, the cafeterias, and the entire facility management layer. They've basically taken the heavy, immovable concept of a corporate headquarters and turned it into an on-demand, scalable product.
And the market for that on-demand product is enormous. I mean, a $500 billion rupee valuation for flex space alone tells me this isn't just a pandemic hangover, right?
I don't know.
It's a permanent structural reset. The total addressable market, the TAM projected for 2026, is 282 million square feet.
Yeah.
And analysts are valuing that space between 474 billion and 592 billion rupees.
And to contextualize that 282 million square feet, you really have to look at traditional commercial real estate absorption rates in major metropolitan hubs.
Or walk me through that.
Well, historically, building out that much premium, grade A office space would take decades, literally decades of capital deployment from traditional developers.
Right.
But the demand profile has shifted so aggressively that this $500 billion rupee market is materializing in a highly compressed time frame.
And here's the statistic from the research that stands out the most to me.
Yeah.
Awfis is the undisputed market leader in India by number of centers, yet their penetration into that 282 million square foot TAM is sitting at roughly 3%.
Only 3%.
Yeah. They have about 8.4 million square feet of total footprint when you factor in their pipeline. That means 97% of this projected market is completely untapped.
That's just
It is
massive.
a land grab in its absolute infancy.
And that 3% penetration rate, I mean, that is the core of the bull thesis.
Right.
The runway for growth is staggering. But to understand why companies are flooding into this 97% untapped space, we have to look at the death of the traditional corporate lease.
Good point.
Under the old blueprint, if a multinational corporation wanted to expand into Bangalore or Hyderabad, they were forced to sign a 10 to 15-year lease agreement.
Which is just a massive capital expenditure trap.
Exactly.
Because you have to hire the architects, right?
Yeah.
You buy the HVAC systems, run miles of Ethernet cable, purchase hundreds of ergonomic chairs, build out the lobby.
Yep.
You are sinking millions of dollars into physical assets before a single employee even boots up a computer.
Right, and beyond that initial capital drain, a 15-year lease just destroys your operational agility.
How so?
Well, if we look at the current global economic environment, corporate headcount requirements are incredibly volatile.
Oh, for sure.
So a tech giant might project needing 800 desks in Pune this year, but following, say, an AI integration or a shift in macroeconomic policy, they might only need 300 desks next year.
Right, and under a traditional lease, they're stuck.
Exactly. That corporation is financially trapped, paying for 500 empty desks for the next decade.
Wow.
Flexible workspaces eliminate that stranded asset risk. Corporations are migrating to these 3 to 12-month setups because it shifts real estate from a massive fixed capital expenditure on the balance sheet to a variable operating expense.
It essentially mirrors the software industry's shift to the cloud.
Oh, that's a great way to put it.
Like traditional commercial real estate is like buying a massive, expensive physical server bank for your office.
Yeah.
You pay a huge upfront cost,
Mhm.
and if your computing needs drop, you're just stuck with depreciating hardware taking up space.
Right.
Office is basically pitching the AWS or, the Netflix subscription model for physical floor space.
Yeah.
You just pay for the square footage you use this month. If you land a massive new contract and need to spin up a 500-seat customized floor, you upgrade your subscription.
Mhm.
If you need to scale back, you turn the dial down without taking a catastrophic financial hit.
And that cloud computing analogy maps perfectly onto the concept of the Global Capability Center, or GCC.
Okay, tell me about GCCs.
Well, they are the massive demographic engine driving this demand in India right now. India is currently experiencing an unprecedented boom in GCCs.
Right.
These are the offshore operational, research, and tech hubs for Fortune 500 companies.
Got it.
When a global bank headquartered in London decides to open a data analytics hub in India, they do not want to become local real estate developers.
Right. They just want to work.
Exactly. They want to land, plug into existing infrastructure, and start working immediately.
That makes perfect sense.
Yeah.
I mean, if I am the head of operations for a European bank, I want my team focusing on algorithmic trading models, not arguing with local municipal contractors in Mumbai about plumbing permits and elevator maintenance.
Exactly.
Office acts as this abstraction layer, handling all that physical friction.
Furthermore, the demographic realities of India actually demand a decentralized approach to these GCCs.
What do you mean by that?
While India's urban population is surging towards 600 million by 2030,
That's huge.
and the workforce is incredibly young, with a median age of 28. Plus, post-pandemic, we have seen this massive reverse migration.
Ah, right. People moving back home.
Yes. Highly skilled software engineers and data scientists move back to their hometowns in Tier 2 cities.
Makes sense.
Corporations realize they can no longer force all that talent to commute to a single, centralized monolith in Bangalore. They need a distributed network of regional hubs.
So the Netflix subscription model for distributed corporate hubs sounds phenomenal for the enterprise client.
It is.
But here's where the mechanical reality of the business model hits a wall.
Right.
Building out millions of square feet of premium, well-certified office space costs an absolute fortune.
Oh, definitely.
I mean, the imported glass partitions, the enterprise-grade routing equipment, the centralized air filtration systems.
Yeah, it adds up fast.
If Office is absorbing all the responsibility for building out these spaces, but they're only getting paid in flexible 3 to 12-month subscription increments, the unit economics seem terrifying. They would need to take on billions in debt just to fund the construction.
And that exact bottleneck is what killed several early iterations of co-working companies globally.
Right, like we saw with some of the earlier players.
Exactly. If you assume 100% of the capital expenditure, You are essentially running a highly leveraged construction company masquerading as a tech startup.
Yeah.
Office realized that to survive, they had to decouple the cost of building the space from the revenue generated by operating it.
Okay.
And that realization birthed their dual revenue model, the straight lease and the managed aggregation model.
Let's break those down because the sources point to this specific architecture as the reason Office hasn't drowned in debt.
Right.
The straight lease or SL model seems like the legacy approach, right?
Yeah, under the straight lease model, Office operates very much like a traditional tenant.
Okay.
They locate a promising commercial property, sign a standard fixed rent lease with the landlord, and then Office funds 100% of the fit-out costs.
So they pay for everything inside.
Exactly. They pay for the carpets, the desks, the acoustic paneling, the wiring, and they carry the fixed rent liability on their balance sheet regardless of whether the space is occupied.
Right.
They then sublease that space flexibly to their enterprise clients, aiming to capture the margin between their fixed costs and the premium flexible rates.
Which carries massive operational leverage.
Oh, huge.
I mean, if the economy is booming and they maintain 90% occupancy, the profits just flow directly to them.
Absolutely.
But if a recession hits and their flexible clients cancel their subscriptions, Office is still legally obligated to pay that fixed monthly rent to the landlord.
Yep.
And they've already burned millions of rupees on the initial construction. It is a highly cyclical, fragile setup.
Which is exactly why Office pivoted heavily toward what they call managed aggregation, or the MA model.
Okay, the MA model.
Yes, this is the financial engine driving their aggressive expansion.
How does it work?
Well, in the managed aggregation model, Office does not act as a traditional tenant. They act as a joint venture partner. Instead of Office paying for the construction, the commercial landlord actually funds anywhere from 50% to 90% of the initial capital expenditure for the fit-outs.
Wait, just to pause on the mechanics of that?
Yeah.
The person who owns the building is writing the checks for the desks, the glass walls, and the server racks inside the office center.
Yes, that is the structural genius of the model.
Wow.
The landlord transforms an empty concrete shell into a fully furnished premium enterprise environment using their own capital.
That's wild.
In exchange for the landlord fronting the cash, Office operates the space under its brand and shares the generated revenue or operating profit with the landlord.
Okay, so it's a profit share.
Exactly. In some structures, Office might offer a minimum baseline guarantee, but fundamentally, it transforms a fixed rent liability into a variable revenue-sharing partnership.
Right.
And this isn't just some peripheral experiment.
That is incredible. Let's look at the financial physics of what happens when you convince someone else to pay for your infrastructure.
Let's do it.
Our research notes that this managed aggregation model generates an astounding 67% return on capital employed, or ROCE.
It's a huge number.
Yeah. To understand how radical that is, we need to compare it to the baseline. In traditional commercial real estate development, a ROCE of 12% to 15% is usually celebrated.
Right.
If you are generating 67%, you are essentially turning capital over with software-like efficiency, but in the physical world.
And we can break down the math of that 67% ROCE to show why it works.
Please do.
So, return on capital employed is simply your operating profit divided by the capital you put into the project.
Right.
Let's look at a hypothetical 100-seat center. If Office had to build it under the straight lease model, they might have to deploy, say, 10 million rupees in initial capex.
Okay.
If that center generates 2 million rupees in annual profit, their ROCE is 20%.
That makes sense.
But under the managed aggregation model, the landlord pays for 8 million of that initial construction.
Oh, wow.
Right. Office only deploys 2 million of their own capital for, proprietary tech or specific branding.
I see where this is going.
Yeah. Even if they split the ultimate profit with the landlord and Office only takes home 1.3 million, their return on that tiny 2 million initial investment skyrockets past 60%.
So they're achieving hypergrowth while remaining remarkably capital light.
Exactly.
I mean, they grew their operational seats by 25% year over year recently, yet they maintain near zero long-term debt and sit in a net cash positive position.
It's unheard of in traditional real estate.
They aren't borrowing from banks at high interest rates. They are leveraging the balance sheets of commercial real estate developers.
And that asset-light velocity is what allows them to open dozens of centers a quarter without diluting equity or taking on crippling debt loads.
I have to put on my skeptic's hat here, though.
Okay, let's hear it.
If we look at this from the perspective of the commercial landlord,
Yeah.
say I own a premium glass tower in Hyderabad.
Right.
If I am already absorbing 90% of the construction costs, buying the Herman Miller chairs, upgrading the HVAC to global standards, and paying the property taxes, why on earth am I giving away a massive percentage of my top-line revenue to Office? Why wouldn't I just hire an operations manager, put a flexible space available sign out front, and capture 100% of the profit myself?
It's a fair question, but the solo landlord hypothesis assumes that physical space is the only variable the client cares about.
Okay.
But the modern enterprise client is buying into a network, not a vacuum.
A network.
Exactly. The concept of network density is why landlords willingly surrender a share of their revenue.
Yeah.
Let's stick with your Hyderabad landlord example.
Sure. Right.
You build a beautiful, flexible space. Now you need to fill it. You are competing against Office, who operates across 58 different micro markets in 18 cities.
And as we discussed earlier, that global capability center for the European Bank doesn't just want an office in Hyderabad. They want 500 seats in Hyderabad, 200 in a Tier 2 city like Bhubaneswar to capture local engineering talent, and a 50-person executive hub in Mumbai.
Precisely. And Office can walk into that European bank and offer a single, unified pan-India contract that covers all 3 locations instantly.
Ah, I see.
They offer a single invoice, a standardized tech platform for access control across all cities, and uniform security protocols.
That is a huge advantage.
A solo landlord in Hyderabad simply cannot compete for that massive enterprise contract because they lack geographic mobility.
Right, they just have the one building.
Exactly. If the landlord tries to go it alone, their premium space might sit empty for 8 months waiting for a local startup to sign a lease.
Which is disastrous.
By partnering with Office, the landlord plugs their empty building directly into a pipeline of Fortune 500 companies and over 80 existing GCC clients. They are trading a percentage of their margin for guaranteed velocity and enterprise-grade tenant quality.
It's like an API for commercial real estate.
Ooh, I like that.
The landlord is just plugging their physical hardware into the Office operating system to access the user base.
That is an incredibly accurate way to model it. Office brings the demand-side aggregation, and the landlords supply the physical nodes on the network.
So Office has successfully engineered a scenario where landlords are eagerly subsidizing their expansion.
Yes.
But what about the other side of the marketplace? How do they keep those high-value enterprise clients from churning?
Right. Retention.
Because the barrier to entry for setting up a desk and a Wi-Fi router isn't exactly insurmountable.
No, it's not.
You have massive global competitors like WeWork India, well-capitalized domestic players like SmartWorks and Indiquip.
Yep.
If a flexible workspace is just an aesthetic commodity, the market inevitably devolves into a brutal price war.
Naturally.
How does Office prevent a 500-person GCC from walking across the street to a WeWork just to shave a few thousand rupees off their monthly overhead?
They avoid the commodity trap by fundamentally transforming what they offer.
How?
They have stopped being a mere provider of square footage and have evolved into an indispensable operational ecosystem.
An ecosystem.
Yeah. To understand their retention strategy, we have to look closely at 2 divisions highlighted in the sources: Office Transform and Office Care.
Oh, right. I was looking at the revenue breakdown of the financial reports, and it is fascinating that a full 30% of Office's total revenue isn't actually generated by renting out shared desks.
Exactly.
It comes from these managed offices, design and build services, and allied operations. Let's start with Office Transform.
Okay.
If a company doesn't want to just move into a pre-existing office center, what does this division do?
So Office Transform acts as a fully backward integrated design and build agency.
What does that mean in practice?
Let's say a major logistics company wants a highly specific, custom-built regional headquarters. They want their own branding, specific spatial flows for different departments, and specialized security infrastructure.
Yeah.
Office doesn't just hand them the keys to a generic floor plan. Office Transform steps in as the primary architect, the general contractor, and the project manager.
They do it all.
They design the space to the client's exact specifications. And because Office builds hundreds of centers a year, they utilize their massive, standardized supply chains to procure materials and execute the build-out faster and more cost-effectively than if the client hired a third-party architectural firm.
And once that custom space is built, Office doesn't just walk away, right?
No, not at all.
That is where Office Care comes in to run the day-to-day operations.
Office Care is the facility management and operational layer. They handle the IT support, maintaining the secure server networks.
Right.
They manage the mobility solutions, the internal storage logistics, and crucially, the food and beverage operations.
They run the food.
Yeah, they literally run the employee cafeterias, manage the cleaning staff, and handle all the preventative maintenance for the HVAC systems.
When you look at the synergy between transform and care, it immediately mirrors the psychology of the Apple ecosystem.
Oh, for sure.
Think about why the churn rate for iPhone users is so incredibly low. It isn't necessarily because the underlying hardware of an Android phone is inferior.
Right.
It's because your Apple Watch is tethered to your iPhone. Your entire extended family communicates via iMessage, your decade of photos is locked in iCloud, and your MacBook seamlessly syncs your passwords.
You're locked in.
The switching costs, both financial and psychological, are extraordinarily high.
And that ecosystem lock-in is exactly what Office is replicating in corporate real estate.
Yes.
If a multinational uses Office Transform to custom design and build their 800-seat regional hub, and then relies on Office Care to secure their internal IT networks, run their employee dining programs, and manage their daily facility logistics.
That's all connected.
Exactly. Untangling that relationship becomes a massive operational headache for the client's HR and operations teams.
Right, because leaving Office to save like 5% on monthly rent at a competitor across the street no longer just means moving desks.
No.
It means you have to hire a new IT vendor to secure your servers, you have to renegotiate catering contracts for your cafeteria, and you have to rebuild your facility management team from scratch.
It's a nightmare.
You are ripping out your company's operational nervous system. The friction of leaving vastly outweighs the minor cost savings of a cheaper lease.
And Office is continuously layering new features into that ecosystem to increase the stickiness, specifically focusing on premiumization and deep expansion into Tier 2 cities.
Let's examine that Tier 2 strategy because historically, premium corporate real estate was exclusively a Tier 1 game.
Totally.
You built in Mumbai, Delhi NCR, and Bangalore, and ignored the rest. Why is Office aggressively pushing into cities like Indore or Jaipur?
It connects directly back to that reverse migration trend we talked about earlier. The talent pool in India has decentralized.
Right, people went home.
Yes. Top-tier software developers and financial analysts have realized they can achieve a significantly higher quality of life, avoid soul-crushing traffic, and reduce their cost of living by working from their hometowns in Tier 2 cities.
Which makes sense.
Multinationals recognize that to retain this elite talent, they had to bring the office to the employee, rather than forcing the employee to relocate to Bangalore.
Okay.
Office anticipated this shift and established early dominance, currently operating centers across 9 different Tier 2 cities.
Wow.
So when a Fortune 500 company wants to set up a 100-person satellite engineering hub in Jaipur to capture local talent, Office is often the only provider capable of offering an enterprise-grade, globally compliant space in that specific micromarket.
You mentioned global compliance, which ties into their premiumization strategy.
Yes.
The sources note they are rolling out these gold and elite center formats, and they specifically highlight achieving the WELL certification for health, safety, and equity.
Right.
Now, to the average person, a WELL certification might just sound like a nice marketing plaque to hang in the lobby.
Sure.
But why does that specific certification act as a moat against smaller competitors?
For a massive multinational, a WELL certification is not a marketing gimmick. It is a strict compliance mandate.
Oh, really?
Yes. The WELL standard is a rigorous, globally recognized framework that measures how a building impacts human health. It looks at air filtration quality, water purity, thermal comfort, acoustic design, and emergency preparedness.
That is extensive.
It is. If you are a global tech giant headquartered in Silicon Valley, your internal ESG guidelines and risk management departments dictate that your employees must work in environments that meet these strict global health standards, regardless of whether that office is in San Francisco or Pune.
So when Office becomes the first co-working provider in India to achieve this specific WELL certification, they essentially pre-clear the compliance hurdles for these massive corporations.
Exactly the point. A cheaper, uncertified local co-working space might offer a lower price per square foot, but they will be instantly disqualified by the multinational's compliance department because they cannot prove their HVAC systems filter particulate matter to a global standard.
Right.
Office uses these certifications to capture the highest margin, most stable tier of the enterprise market.
Okay, let's synthesize the blueprint we have explored so far.
Sounds good.
Office operates in a $500 billion rupee totally addressable market that is 97% untapped. They have engineered a managed aggregation model where landlords fund the heavy capital expenditure, resulting in a phenomenal 67% return on capital employed.
Yep.
They have woven an incredibly sticky Apple-like operational ecosystem that locks in multinational clients through design, IT, and facility management.
Right.
And they are executing a highly strategic expansion into high-growth Tier 2 markets while maintaining rigorous global health certifications.
On paper, looking purely at the operational architecture and the market tailwinds, the business model appears exceptionally robust and highly optimized for the current macroeconomic environment.
Which brings us to the financial paradox that sits at the center of this entire analysis.
Here we go.
Because if everything we just discussed is mechanically true, the financial metrics should be pristine, and the stock should be commanding a massive premium on the public markets.
Absolutely.
But there's a glaring, massive contradiction staring us in the face in these source documents. We have two completely diverging narratives.
Yeah.
Let's walk through the numbers, starting with the bull case, the raw financial output of the engine they built.
The top-line operational metrics are, frankly, spectacular.
Give me the numbers.
If we look at their trailing 12-month or TTM sales, Awfis had hit 14.23 billion rupees.
Wow.
In the third quarter of FY26 alone, their operating revenue surged 20% year over year to 382 crore. And if we zoom out to the broader picture of FY25, they grew total revenue by an astounding 42%.
And it is crucial to point out that this isn't just like empty top-line vanity growth where they are bleeding cash to acquire customers.
Not at all.
They are actually expanding their profitability margins while scaling. The sources show their operating EBITDA margins, which is a measure of their core operational profitability before interest, taxes, depreciation, and amortization expanded by 710 basis points to reach a very robust 36% to 37.8%.
To understand the mechanics of that 710 basis point EBITDA expansion, we have to look back at the managed aggregation model.
Oh, how does that connect?
Because landlords are absorbing the fixed capital expenditure of building new centers, Awfis doesn't have massive depreciation costs dragging down their profitability.
Right.
As a center matures and moves from, say, 50% occupancy to 85% occupancy, almost all of that incremental revenue from the new clients falls directly to the bottom line.
That makes total sense.
That operational leverage is what drives a 233% year-over-year surge in their Q1 FY26 net profit. The underlying business engine is converting space into cash with brutal efficiency.
They have low debt, they maintain a net cash position, and their blended occupancy rate across the entire portfolio is a healthy 73%. For mature centers that have been open for over a year, that occupancy rate jumps to 84%. Every operational KPI is flashing bright green.
Which forces us to look at the bear case.
Yeah, the dark side.
Because despite a 42% surge in revenue and massively expanding profit margins, our sources reveal that over the past year, the Awfis stock price has plummeted by roughly 49% to 51%.
Nearly half of the company's total market capitalization has simply vanished.
That's staggering.
So what does this all mean? How does the company grow its top-line revenue by over 40%, aggressively expand its profit margins, cement its position as the undisputed market leader, and simultaneously watch half of its market value evaporate into thin air?
It's wild.
It feels like we are analyzing two completely different companies.
To untangle that paradox, we have to stop looking at the operational spreadsheet and start looking directly at the boardroom dynamics.
Okay, the boardroom.
We need to unpack the capital allocation red flags and what the market perceives as a severe governance black box.
Right.
Institutional investors, the massive mutual funds and foreign portfolio investors who actually dictate stock prices, do not just buy revenue growth, they buy management conviction.
That's a great point.
And the most alarming piece of data in our entire stack of sources revolves around the actions of the promoters, specifically Amit Ramani, the chairman and managing director.
Let's walk through the specific timeline of his stock ownership, because the speed of the sell down is what seems to be spooking the market.
Definitely.
Awfis had their initial public offering on May 30, 2024.
Prior to that IPO, around March 2024, the promoter stake was sitting at a solid 28.56%.
Okay.
But over the following 21 months, the data shows a dramatic and consistent reduction in that ownership stake.
How dramatic?
By December 2024, the promoter holding dropped to 20.44%. By June 2025, it slipped further to 20.31%. And by December 2025, the promoter holding had crashed down to just 17.01%.
Wow. Let's do the math on that trajectory. Going from 28.56% down to 17.01% represents a 40.5% reduction in the promoter's total ownership stake in under 2 years following the IPO.
Yep.
And the sources note that a massive chunk of that dilution, a 27% decline, happened in a single, highly compressed quarter between September and December 2024.
Now, to be entirely objective with the data, our sources do clarify that a portion of this percentage drop is mathematically tied to post-IPO share issuance.
Oh, right.
When a company goes public and issues new shares, the total pool of stock expands, which naturally dilutes the percentage ownership of existing holders, even if they don't sell a single share.
Gotcha.
It isn't necessarily just the promoter aggressively dumping stock on the open market every day. Furthermore, the data shows they currently have 0% pledged shares.
Which is an important distinction.
Very important.
A pledged share is when a founder uses their company stock as collateral to secure a personal bank loan. If the stock price drops too far, the bank can force a liquidation, creating a catastrophic downward spiral. Having 0% pledged shares means there isn't an immediate risk of a forced margin call.
True. But optics matter deeply in public markets.
Oh, absolutely.
Even factoring in natural dilution, watching the founder's stake shrink from nearly 29% to 17% in 21 months triggers massive alarm bells for institutional capital.
Right.
If you are a mutual fund manager considering deploying $50 million into Awfis for a 10-year hold, your foundational requirement is that the captain of the ship has a massive, undeniable vested financial interest in the long-term journey.
Right. Skin in the game.
Exactly. When they see the promoter's stake shrinking that rapidly, the immediate assumption is a lack of internal conviction.
But the shrinking promoter stake is only half of the bear thesis. The market is also heavily penalizing them for what we don't know.
Right.
The sources emphasize this concept of a governance black box.
The stock market can price in bad news, but it absolutely despises uncertainty. And right now, the internal mechanics of Awfis's corporate governance are incredibly opaque. Our research explicitly points out an alarming lack of public information regarding executive compensation structures.
We don't know what they're paying themselves.
Exactly. We don't have clear visibility into the board structure, the specific composition of risk management committees, or the protocols surrounding related party
I
transactions.
saw a lot of unknown.
There is also a distinct lack of clarity regarding mechanisms designed to protect minority shareholders.
We don't even have a clear picture of the management bench strength beyond Amit Ramani. If you were to step down tomorrow, is there a robust succession plan?
Nobody knows.
The market has no idea. So if we put ourselves in the shoes of an institutional investor,
Right.
you are looking at a company where the founder's ownership is shrinking rapidly post-IPO, and simultaneously, the company is operating behind a curtain regarding how capital is allocated internally, how executives are incentivized, and who actually holds the power on the board.
Yeah.
Regardless of how pristine the 42% revenue growth looks today, you cannot confidently project that success 10 years into the future without governance clarity.
And that lack of clarity translates directly into mathematical valuation. Institutional investors apply what is known as a governance discount.
How does that work?
When they build their financial models to determine what the stock is worth, they look at the governance black box, and they artificially raise their discount rate or apply a haircut to the valuation multiple. They are essentially saying, the operational engine is brilliant, but because we cannot trust the pilots, we will only pay 50 cents on the dollar for this asset.
Right.
That governance discount is a massive structural contributor to the 50% stock drop. They are heavily pricing in the unknown.
And speaking of pricing in the unknown, the stock market is inherently forward-looking.
Yes.
A 50% drop implies that Wall Street isn't just worried about executive pay. They're likely projecting future structural risks that haven't manifested on the current balance sheet.
Very true.
Which brings us to the final phase of our deep dive. Stress testing the Awfis blueprint. What are the foundational cracks in this empire?
Let's get into it.
When we look past the current boom cycle, what could realistically trigger a collapse?
The most immediate and unavoidable risk is macroeconomic cyclicality.
Okay, economic cycle.
Awfis is currently thriving because the broader Indian economy is in an expansionary phase. The IT sector is growing, the banking, financial services, and insurance sectors are expanding, and foreign capital is funding massive GCC buildouts.
Right.
However, the flexible workspace industry is intrinsically tied to discretionary corporate spending, making it highly sensitive to economic downturns.
This is where the AWS or Netflix subscription analogy we used earlier reveals its dark side.
Exactly.
If a corporation signs a 15-year traditional commercial lease and a brutal global recession hits in year 3, they are legally bound to pay rent for the next 12 years.
Yep.
The traditional landlord is insulated from the immediate shock.
Right.
But if that same corporation is on a flexible 3 to 12-month lease with Office, and their global headquarters mandates a 15% reduction in global headcount to survive the recession, what happens?
The revenue evaporates almost overnight.
Wow.
During a downturn, enterprise clients will immediately consolidate operations, abandon their flexible regional hubs, and pull their remaining workforce back into whatever core real estate they actually own.
That makes sense.
Office's financial model relies heavily on maintaining that 73% overall occupancy rate to sustain those lucrative 36% EBITDA margins.
Right.
If a recession triggers a sudden exodus of flexible clients, Office's revenue would crater, their margins would compress instantly, and they would likely be forced into a race-to-the-bottom price war with WeWork and SmartWorks just to maintain basic cash flow.
It's the double-edged sword of selling agility. The frictionless ease of signing up for a 500-seat floor is identical to the frictionless ease of canceling it.
Exactly.
They have internalized all the macroeconomic volatility that traditional landlords use to force onto the tenant.
Yes, they have.
But let's examine the second major structural risk, which targets their secret weapon, the managed aggregation model.
Okay.
We spent a lot of time marveling at how brilliant it is that landlords fund 50% to 90% of the construction costs. How does that exact strength transform into a vulnerability?
The vulnerability lies in the shifting balance of power and leverage.
Leverage.
Right now, Office is the dominant market maker. They approach a landlord and dictate highly favorable revenue share terms because the landlord is desperate for access to Office's pipeline of global GCC clients.
Right.
But by proving that this asset-light model generates massive returns, Office is inadvertently educating the entire real estate market.
Oh. They are providing a masterclass to landlords on exactly how lucrative the flexible workspace sector can be.
Precisely the danger. As the sector matures, landlords gain operational confidence. Imagine a landlord who signed a 3-year managed aggregation contract with Office. During those 3 years, the landlord watches how the space is run, observes the tech integration, and realizes the initial construction, which they paid for, is already completed.
Oh, I see where this is going.
Right. When that contract comes up for renewal, the landlord might approach Office and say, "You have been taking 30% of the profits, but now that the space is built and the clients are established, I want a larger split.
Right.
If you refuse, I will simply hire a local facility management team to run it myself, or I will hand the contract to a competitor who will accept a 15% cut."
Which instantly squeezes Office's profit margins.
Exactly.
The core fragility is that Office does not actually own the underlying physical asset that generates their cash flow.
They don't.
They are entirely dependent on the continuous goodwill, cooperation, and contract renewals of third-party property owners.
Yes.
If landlords collectively decide to squeeze Office on margins, or if Office loses even 10% to 15% of their managed aggregation seats due to contract disputes, it would materially damage their long-term profitability.
That lack of asset ownership is a massive theoretical risk that hasn't been fully tested in a mature market cycle yet.
Right.
And layered on top of that landlord leverage is the third major risk profile: regulatory fragmentation and technological disruption.
Let's start with the regulatory side, because operating across 18 different Indian cities is a massive logistical undertaking.
Operating in 18 cities means navigating 18 distinct municipal corporations.
Sounds complicated.
Currently, the regulatory framework surrounding flexible workspaces is relatively permissive because the sector is still classified as nascent.
Right.
But as it balloons into a half-trillion rupee industry, government scrutiny will inevitably follow.
For sure.
What happens if municipal bodies decide to reclassify flexible workspaces and impose heavy new commercial property taxes on short-term leases?
Oh, that would hurt.
Or what if state governments introduce stringent new labor laws governing the gig workers, cafeteria staff, and facility management teams that power office care?
Right.
Navigating a patchwork of aggressive new compliance regulations across 58 micromarkets could severely inflate their baseline operational costs.
And on the technological disruption front, Office currently holds an edge with their integrated apps and unified booking systems, but technology in real estate is accelerating rapidly.
The barrier to entry for real estate tech is lowering.
Okay.
What happens if a globally funded tech behemoth decides to enter the Indian market with a vastly superior AI-driven space optimization engine that allows for microscopic dynamic pricing based on hourly demand?
Wow, yeah.
Or what if a massive real estate investment trust or REIT decides to bypass middlemen entirely, utilizing their massive pools of cheap capital to build their own flexible networks at scale?
They have the money to do it.
Exactly. Office cannot afford to stand still. They have to continuously sink massive amounts of capital into their tech stack and ecosystem upgrades just to maintain parity, which places constant pressure on their cash reserves.
So when we synthesize these interconnected risks, the extreme vulnerability to macroeconomic downturns, the fragile reliance on landlord partnerships for their core MA model, and the looming threats of regulatory crackdowns and tech disruption, you arrive at an incredible, almost poetic irony regarding the fundamental nature of Office Space Solutions.
Explain the irony.
The ultimate irony is that the very concept of flexibility that makes Office so incredibly attractive to corporate clients right now,
Yeah.
the exact product feature that allowed them to capture 134,000 seats and grow revenue by 42% last year, is the exact same feature that makes their entire business structurally vulnerable to collapse.
Wow, yeah.
They're selling agility and safety to their enterprise clients, but in doing so, Office has absorbed all the shockwaves of the global economy.
Right.
The client gets to remain safe, nimble, and unburdened by fixed assets. Office has to stand in the storm and absorb the volatility.
That is a profound synthesis of their market position. It is fundamentally a massive transfer of risk.
Yes.
In the 20th century, traditional landlords transferred all the economic risk to the tenant via the unbreakable 15-year lease.
Right.
Today, Office steps in and absorbs that risk entirely, hoping that their massive pan-India scale, their network density, and their deep ecosystem integrations will act as a sufficient shock absorber when the economy inevitably falters.
And clearly, looking at the brutal reality of that 50% drop in the stock price, institutional investors are staring at the governance black box. They're watching the promoter stake shrink, and they are deeply questioning whether that shock absorber is actually strong enough to survive a legitimate economic pothole.
To synthesize everything we have uncovered in this extensive deep dive,
Yeah, let's wrap it up.
Office represents a truly fascinating, high-stakes case study in modern corporate strategy. On one hand, you have to acknowledge their brilliance. They are executing flawlessly on a massive, structural, half-trillion rupee shift in how the Indian workforce operates.
For sure.
They pioneered an ingenious, highly profitable, managed aggregation model that allows them to capture market share at an astonishing velocity without drowning in debt.
Right.
But simultaneously, they are plagued by deep existential questions regarding management transparency, an untested reliance on landlord goodwill, and a highly cyclical revenue model that has never truly been stress-tested by a severe, prolonged recession.
It is the ultimate collision between the theoretical perfection of a financial spreadsheet and the unpredictable reality of market cycles, human behavior, and corporate governance.
Very well put.
Which leaves us with a final, somewhat philosophical question to ponder as we wrap up this deep dive.
Okay.
We started by talking about the blueprint of the modern workforce and how that rigid 15-year lease blueprint has been torn up and replaced by a mandate for absolute, frictionless flexibility.
A shift that seems irreversible at this point.
But if ultimate flexibility truly becomes the premium default product of the global future, what happens when every single major corporation relies entirely on on-demand rented real estate?
Right.
Does the concept of a permanent corporate headquarters, a physical manifestation of a company's identity and culture, die completely?
It's a huge question.
Do infrastructure middlemen like Office essentially become the new undisputed masters of the global workforce, dictating where, how, and at what price millions of people work every single day? Or will human nature, corporate ego, and the deep-seated desire for control eventually swing the pendulum back? Will enterprise companies eventually demand the permanence and the ownership of drawing up their very own rigid architectural blueprint once again?
Something to think about.
It's definitely something to seriously think about the next time you walk into a sleek, glass-walled office, grab an artisanal coffee, and wonder who really owns the chair you're sitting in.